So Brian Ladd, the Ladd Group at Cascade Sotheby's, Steve LaCrosse, he's the operations manager and broker on the team. And we try to do these about every 2 months or so. And we think right now is a very relevant time to talk about real estate because there's been a lot happening, especially in the last couple of years. And we are at a very, we're at an inflection point. We're at a point where the market is starting to show signs of normalcy. And we're undoing that pandemic rush we had in buying and selling, in migration, in behavior, in how people use housing. And so we're starting to undo some of those trends, and change is tough. Change is scary. But what we're going to try to do is remain up at that 30,000 foot view, because when we look at the data, from that level, we see it as a lot less scary, and we can make better decisions with our clients than reacting to the day-to-day news. Steve, do you have anything to add to that?
Yeah, I think, as we go through, I know we're going to kind of lay out what our agenda is for the day. And, one of those things is making sense of these headlines. Like Brian said, when you pull back a little bit, it allows you to see the big picture. I think, certainly one of the things that my clients are used to is when they ask questions like, how's the market? Or, should I do this or should I do that? It's really important. Most of the time I follow it up with a question back to them, because a headline can say a certain thing, a data point can say a certain thing, but until you know the context of what we're talking about, or what's important to you, it's really hard to just focus on one thing or another. Going into some of those headlines and some of the data points that you look at, it's really interesting, because you can have these two what seem like conflicting data points. One saying one thing at a very alarming rate, the next day you're seeing something that says almost the exact opposite at an also equally alarming rate. And we'll go into a couple of examples of those as we kind of dive into the data a little bit more. So we do think it's important to know the information, know what's happening in the market. That's why we're going to be going over the general data as well as Ben's specific data, what's happening nationally, what's happening here with regard to prices, interest rates, new listings, all of that. But, Brian, you've said this a few times on either your market updates or other webinars. Headlines do more to terrify than clarify.
Yeah, and we at the Ladd Group have no incentive to try to convince people to buy or sell. I've been doing this for 20 some years. We are the largest group in the state, and we do that with 7 of us here in Central Oregon. And we're going to be here regardless of trends. But what we often find is that these headlines are incredibly conflicted. They're done by journalists that are dipping their toes in the housing market because it's exciting for them, and they throw out a few articles, and they're completely they're inaccurate for the most part. And when we look, what we're going to try to do is to try to pull back, look at the real data, look at not the day to day, it's the month to month, the year to year, decade to decade, and then go back to the underpinnings, the fundamental factors that affect housing, of supply and demand. And when you look at some of those factors, it's easier to kind of put all these crazy headlines into context and have a more logical discussion, because when you have fear around your decisions, whether you're going to miss the market because it's going up or you think it's going to crash, that's how mistakes are made in real estate. Some of the headlines we're looking at right now: U.S. foreclosures filings surged 115%. Potential risks of price declines in the real estate market, top 10 markets that are going to crash this year, et cetera, et cetera, et cetera. Most of these are inflammatory. And when we look at the real data, it's a very different world. And let's start, Steve, do you want to kind of address the whole foreclosures thing? Because that's something that's exciting to talk about, because 100% increase in foreclosures, I think that's going to misinform a lot of people, especially buyers that are waiting for a flood of foreclosures, because 115% looks big, right?
It does. Yep. And so, just quickly here, this is just a quick poll that we pulled up. At 67% of Americans think that the housing market is set to crash in the next 3 years. we'll go into more of why people think that, and some of the differences between the last time and this time. But this is the data right here that goes through that headline. That is an accurate headline, that foreclosure filings are up 115% from 2021 to 2022. But the reality is they're actually down. This is when you look at it in perspective. This is that 30,000 foot view. You pull back and you say, okay, how are they in relation to 2019 pre-pandemic? They're down about 40%. Where are they in relation to 2008, 2009, 2010, which everyone remembers? And they're 90% less than they were at that time. And so, that's the stuff that, yes, it's accurate to say they've gone up. They've more than doubled in the last year. But in the last 2 years, there was a moratorium on foreclosures. There were forbearance programs that prevented people from going into foreclosure. And so there were things that were in place that kept those numbers artificially low. We are less.
And so a buyer, I can understand why they think real estate's going to crash when they see a headline that's saying foreclosures are up 100%. When that's a fun headline, it gets people to click on their websites or whatever. But when you look at it, even today's foreclosure numbers are at like a 20-year low, even with that increase. So it's a little bit of a return to normalcy, but this is nothing like the last housing crash in any way, shape, or form. So I think that's just, there's a lot of different data points out there that the journalists are circulating that are just as inflammatory and just as misleading. So, this is Bill McBride, founder of Calculated Risk. He said the bottom line is that sure, there'll be an increase, but this will not lead to a cascading price declines like what we saw in 2008. It's just, it's not going to happen. The other thing that we're dealing with is the interest rates. And right now, we've tied very closely with interest rates as far as market activity. Sometimes interest rates are a minor factor in what's happening in real estate, but with the huge affordability issues we got to admit it, housing prices are expensive, not only in Bend, but nationwide. And when they're as expensive as they are, and we jump from 2.75 to over 6.5, 7%, that dramatically changes one's ability to pay the monthly mortgage. And right now, because of what we're dealing with inflation in the nation, that has kind of been pushed around by the Fed, and it's not a direct correlation, but it's largely linked. And with their policies of these interest rates going up, it was what slowed down sales in that second half of 2022. And we're going to look at some more data on that. But as interest rates go up and down over the next 1 to 2 to 3 quarters, that's going to probably be the one data point that's going to most directly track buyer and seller activity. Steve, would you agree with that?
Yeah, I mean, it's certainly what we've seen over the last 6 months. As to start last year, we all know interest rates doubled from the point of the beginning of the year until roughly May and June. And there were at least 2 instances in the second half of the year where buyer activity and activity in the market picked up as interest rates came off those highs. And then they started back up again and things started to slow. And I will say just one anecdotal point about interest rates. It was interesting to hear as we were surging and we made it to 6%, things came back down again. Then they bumped back up to over 7%. At first, that conversation was, oh my gosh, I can't believe they're at 6%. Later in the year, when they got back to 6% after being above 7%, the perspective had changed and it was, oh, interest rates are at 6%. It's the same
when
statement.
we saw interest rates hit 6% there for, what was it, a couple weeks in December?
Yeah.
Sales went through the roof, and January was one of the highest sales months that we've experienced in many years. So the other big constraint on why sales are down, and we're going to get to the variety of reasons on this, is there is simply very few homes on the market, not only here in Bend, but this is nationwide. This shows that where we were at in inventory every year, 2017, 18, all the way through 2022. And 2022 was one of the lowest years in recorded history of how few homes there were available. Part of this has to do with the fact that when interest rates have doubled, anyone with a low interest rate doesn't want to sell, because if they want to move laterally or up and down a few $100,000, a doubling in the interest rate penalizes them. So what we're seeing is a lot less turnover, especially in the resale market. So there's a lot fewer homes to choose from. And so another one of those headlines that we were talking about, hey, sales are down 50%. That's because there's very few homes on the market to sell. Let's look at this. This is local housing inventory. Now, this is months of supply. Now, generally in Bend, historically, we've had about a 5 to 6 month average of supply. And over the last few years, this is 2020, 2021, 2022, we've been at about 3 months peak every year, down to about 1 month, which was unheard of. And right now, we're at 2.6 months of housing. So that's up 85% year over year. And there's different ways to measure this. And I just got a newsletter from another agent in town, a great agent, but his headline was inventory's up. He was using a different metric. I'm using single family housing. I think he was using overall market, including lots and whatnot. But he said inventory's up 130%. Steve, did you see that one?
Yeah, it was new listings, and it was one of those headlines where new listings were up over 100% where they were month over month, but they're still historic. They're 30% lower than they've been at any other point in time. And December was the lowest on record that we have going back 20 years. We went back as far as we could on the data. And so again, it's accurate, but the perspective is this.
Yeah, so right now, if you look at the very right side of this, this shows us going from 2022 into 2023. And you can have 100% increase in the amount of inventory over last year, and we're still about 30–40% of our historical norm. And so this goes all the way back to 2004. Another point on here that I've talked about before, where people are worried and they see inventory growing and they're like, the end is coming, prices are going to crash. It's 2007, 8 all over again. What's really interesting is that prices didn't start going down in Bend until, what was it, Q2, Q3, 2007, kind of Q3, 2007. But what was interesting is that the inventory started to increase about 15 months, day over day, for 15 months straight. The inventory increased before that pricing started to really crash in a material way. The price pullback that we've seen on the backside of 2022 really had to do with the fact that the interest rates doubled and we unwound the pandemic demand. It wasn't a systemic supply and demand issue, which is what drive big trends in housing prices. These are small trend drivers of interest rates. The big trend drivers are historically 1990s, 1980s, 1970s. Builders used to be able to overbuild, and when they had a huge surplus of housing, prices would go down for 2 or 3 years, and then they would climb for 7 or 8. What we saw in 2007, 8 was a complete anomaly. We've discussed this ad nauseum, happy to discuss it one-on-one with you again, but that inventory got to about 20 months, which meant almost 2 years of housing before the prices really felt that oversupply. Right now, we're still at 2.6 months of inventory. We would have to have almost an 8x on that inventory to have that same downward pricing. It is such a different world. But I think that if you're only looking at the headlines, it's scary, right, Steve?
Yeah, and it brings up the point that we've gone through a few times. Ultimately, housing comes down to supply and demand. There's the supply end of the equation. There's obviously the demand end of the equation, which is buyer affordability, interest rates, what that's done to what people can afford. And as those that we, I think one of the goals, maybe back up here for a second, one of the goals for today is we're not trying to paint a certain picture of this is all rosy and this is only upside from here. And we're just trying to paint the picture of there aren't a lot of indicators. I mean, people thought going into the winter, coming off the run that we had, that we'd see some of the signs of these corrections. And we're just trying to point out some of those reasons why there haven't been the big signs that you thought might have been coming. Going into a winter where it's historically a slow time of year, there are these other factors like interest rates and low supply and, some of the things that we talk about in our state of the market report, which will be coming out here momentarily, almost any day. So anyway, I guess the point is it's a supply and demand market, and that is what really at the end of the day drives prices. And Brian, if you want to talk about the slide that we have.
This is just a nationwide summary showing months of inventory. Nationwide, we're at about a 3-month inventory, so about what we're seeing in Bend. And this shows you where we were at in 2006, 7, 8, 9, 10, 11, 12. So if anyone's worried about a glut of inventory hitting the market and that crashing prices, I think we're going to have to look to other reasons to support that belief.
Yeah.
Let's talk about, because I think values and pricing is what people want to kind of funnel down to. What's happening? Back in 2022, the first 5 months were some of the strongest appreciation that we've seen in history. That was really the final gasp of that pandemic migration, pandemic buyer behavior, trying to take advantage of these interest rates before they got too high. And we were seeing month over month appreciation anywhere from about 1.5% to about 3.5%. And that is absolutely an anomaly. And we started to see that unwind kind of mid-year, right? This is when the Fed really started fighting inflation. They started, jacking up that overnight Fed funds rate that went all the way through the T-bills, 10-year Treasury, all the way down to mortgage rates. And we started seeing some negative appreciation. This is nationwide, anywhere from about 0.5% to 1% a month. But what we're really starting to see is the data that's coming out from December and January, which we have our own microcosm because we do a couple hundred transactions a year here in Bend. We're already finding support and normalcy and activity now that there's been a more of a flatlining in the interest rates. And we feel that, we're not to say that, interest rates, prices won't go down a little bit more from here. But we're certainly seeing a lot of activity. We're seeing buyers trying to buy. Steve, would you agree with that?
Excuse me. Yes, I would. There's no question. Buyer activity is a reflection of both interest rates. And then the other piece that we haven't really touched on is what's happening in the stock market. That also affects buyers who are using cash. And what happens to that when the stock market goes down? People aren't as eager to jump in because they're having to realize a loss on their asset, liquidate, and then get into obviously real estate, another asset. And so the fluctuations in there are what are affecting people's willingness to buy. But going back to that slide, I will also point out, most of my clients know my last career was a futures trader for 15 years. And those gains that we saw at the beginning of the year are not sustainable. And what we want to see is a soft, slow correction. That's what the Fed has been shooting for on their end with inflation, is a soft correction. It's a leveling out. You don't want to see the big spikes. And so what we've seen in prices over the last few months is what we would have expected to see. And it's more in line with what a healthy, stable, normal market should see and what we should see yearly. So I'm pleased with what we've seen, and the support that we found is a direct reflection of all of those sub factors that make up that buyer demand portion of it.
No, that's perfect. Yes. The graph we have here is average sales price per Bend. We're right about 800,000 as an average sale price right now. It's still tough to say that number. But what you can see on the far right of this is that tail back up, which we're talking about. We saw that activity come back in November, December, January, largely tied to the interest rates coming back down a little bit. But that's that strength that we're kind of feeling. So when you hear people saying prices are crashed, it kind of depends what data point you look at, right? Because you can fool yourself into a lot of things. If we use a rolling average compare ourselves, we're up 2% year over year. Where we're down is off of that hump that we saw in April, May, June, right? And a lot of people are freaked out and say, oh, prices are down 30-40%. It's just not the fact. The big price corrections that most people are talking about have to do with houses that went on the market in exuberant market Q1, Q2 last year, and they told their realtor it only takes one buyer. My neighbor sold for $100,000 more than they asked for. We're going to price it high in the sky. And they were taking this record appreciation and extrapolating into the ether. And those are the houses that we're seeing make huge price corrections, 1, 2, 500,000 and still not selling. Those are not off of true sales points. Those were mostly aspirational pricing that was never supported. What we're seeing is that we're only down about 6% from peak to where we stand now. So a lot of people, if you were to ask and say, hey, a poll, how far is pricing down and been in the last 6 months to a year? Most people would give you double-digit answers based on emotion. But when we look at the data, we're only down about 6% from peak. And I can pull up a graph of 30 years here in Bend. To be honest, on average, there's about 8 to 10% peak to trough pricing every year, where May, June, July pricing is about 6, 8, 10% above what you see in November, December pricing anyways. So if you look at the numbers, that pullback in prices that we saw is about in line with average. I'm not to say that there isn't some, other factors at play here, but it's not as inflammatory and not as dramatic as many may lead you to believe.
One thing I'll throw in there, it's related to days on market, as you were talking about selling and kind of shooting for aspirational prices, and what it looks like in terms of sale prices. There is a good chunk of the market, as people have been more selective and homes have taken a little bit longer to sell. There is still, it's somewhere between 23 and 25% of the market is still selling quickly and selling within a week. So of all of the sales of Q4, and I believe it held true again for the first month, I don't want to take too small of a data set because the numbers are so small that it can lead to wild numbers. But if you look at the Q4 as a whole, 25% of the market still sold within a week, even though the days on market went from about 5 to about 30. And so again, it's that sales price and that asking price are very important numbers, because if it is priced well, there is activity.
Yeah, we're definitely finding activity for appropriately priced houses. Buyers are there, they're trying to buy, but they're not going to be illogical about it, or they may not be able to stretch given today's affordability issues, both in average sales price, but also the interest rate. But if it's appropriate and it's a well-marketed, well-positioned home, we're selling those homes quite quickly. Another headline that you may see that freaks everybody out is sales are down 50%. And you're going to see this headline come out nationally for the next 2, 3, 4 months, just like we're going to see in prices. Prices are down, prices are down, prices are down. What they're talking about is prices in March or April or May of 2023 compared to that month last year are going to be down, but you're taking these small snapshots in time, and when you look year-over-year averages, etc., it's much more nuanced and much more calm. The pending sales, I think, is largely a reflection of, as we talked about, the inventory is not there, and then the interest rate rise. And so, I guess this gets to that question that you were just talking about, Steve, is what's the negotiating happening between buyers and sellers at this point? And I think this is an interesting graph that we can talk about.
Yep. So historically, what we've seen in Bend is that on average, homes sell right around somewhere between 97, 98% of asking price. We always like to point out asking price is the seller's belief and their broker's belief of what that price is. That's really all it is. So, that number isn't an end all be all. There are times where you should pay 10% over asking price because they've priced it too low. And there are other times you wouldn't touch asking price with a 10-foot pole. So, but we had, it's what does this chart go back to? 2013, pretty darn consistent, somewhere between 96 and 98% of asking price. During the pandemic, we shot up to 104%. Almost every deal was, regardless of what the house was and where it was, people were willing to pay at or above asking price. We're back down to 98% now. So we are right back within that range of what we historically see. So in general, people do have a little negotiating power. There still are opportunities to get it for less than that, to get it for 90% or 95%, or even some cases less. But the reality is, on average, it's pretty darn close. And then, like I said, there is that segment of, if it's priced well, you should pay listing price, and 25% of the market is doing that or very close to it in the first 5 or 6 days that a house is on the market. So, again, it's way down from where it was in 2021, but when you look at that chart over 10 years, we're back to a normal market.
Yeah, and I think there's power in this one right here, because given the headlines that we just talked about, I think there are sellers that could undersell their home at this point because of the bad news, and sell it for less than truly what it's worth. And likewise, I also think there's buying opportunity, because there are sellers that came on last year, were misled in pricing or confused, or they had it in their belief that it had to sell at that. They priced too high. They've had 6 months of price decreases, and they're very fearful of the future. And I think there could be some emotional opportunity there for buyers to go get those homes that failed to sell last year, that have been on the market continuously, or went on the market, had price drops, came off the market, coming back on the market this spring. And so I think there's going to be some opportunities for those that are looking at the data with a little more critical eye and not as emotionally.
And one thing that I'll throw in there is, obviously, like I was saying, we like to ask questions to our clients. One of the things that we do like to ask is, as people search for the lowest price, they want to make an offer that's, 5 or 10% under asking, because they're trying to get it for the best price. The questions that we will ask are, what would happen if we were to miss out on this one, interest rates were to go up, or interest rates were to go down, or how important is it to you? How long do you have in your current house? What are some of those other factors? Because I think it's just like with a loan, if you get so focused on the interest rate, you end up missing out on some other details that are really important to the equation. So
yeah,
again,
I think the one thing that home buyers and home sellers get so myopic on is the price. And I understand that that's relevant. But when you actually look at the cost of home ownership, interest has just as big or a larger or bigger factor in your cost of ownership. But then likewise with sellers, sometimes they get caught up in that last 1, 2, 3% of premium. But we've often seen that come at a cost. And what all sellers believe is that all homes sell right away. And I want to deliver the bad news to you. I think it's about 40% of homes fail to sell their first time on market in the first 6-9 months with their agent, and they change agents, things like that. And that causes massive disruption to people's lives. They aren't able to make the move for a job. They're not able to sell that house and get a different house with the extra bedroom for their children. They go into, they fail to sell in the summer. Then they have to put their whole life on hold and then re-prep and try to sell that home in the spring. And meanwhile, they're living with stuff in storage because they're trying to there's massive disruption that happens over that final couple percent. So we always try to make, if you look at the bell curve of probability, all sellers want to sell on the far right side of that probability curve when the majority of the sales happen in the middle. So these are the type of discussions that we get in with our buyers and sellers. And the reason I'm talking about this is what Steve says is that we have questions and discussion with our sellers and buyers to truly understand what are all the other factors. Let's not get too myopic on just the price.
And if the answer is the price is the most important thing, the price is the most important thing.
Okay, so and we're getting a little long. I want to be cognizant of everyone's time. Another headline that we're getting, because there's a lot of people that believe that we're coming into a recession. And the belief historically is from the general public is how is a recession going to impact housing? I can't say if we're going to have a soft landing and avoid this recession or we're going to land in it. But a recession does not mean falling prices, period. The big 2008 recession, they were absolutely directly correlated. But 4 of the last 6 recessions have actually had positive price appreciation, especially during inflationary times like what we're dealing with right now. So we've talked about this a lot in the past. I don't want to get too myopic on it, but it's not there. What is good about a recession is that the way the Fed gets our economy through a recession is generally lowering interest rates, because a recession just means buyers are not buying in the overall market. They're not spending money. There's not enough money in circulation, and to get money in circulation, they offer cheap debt and they flood the system with money. So if we're at a pause that's largely driven by high interest rates right now, a recession could actually positively benefit housing, because that will drive down interest rates. And if we look at I think we have the last 6 recessions. Those are in gray, the big gray stripes in 80, 81, 91, etc. During those times, interest rates, mortgage rates generally fall. So if we foresee a recession coming in 2023, more likely than not, that's going to help drive down mortgage rates, and that'll actually probably increase buying activity and have more of an impact on housing than the recession. Fair statement, Steve?
Yeah, absolutely. Obviously this summarizes what Brian was just saying. The experts have their predictions on what interest rates will do. We saw last year they were wildly off. The reality is, and I think this is the general consensus across the board, the days of the 3% and 4% interest rates are more than likely in the rearview mirror. Those were artificially at those levels for various reasons, which we can get into. So the reality is we're now trying to establish our new normal range. And with that, people will it will drive some people out of the market. And for others, it will just maybe adjust what they're looking at and how much they can afford. But regardless, I mean, this summarizes what we see at these various levels. The reason we see some of the stronger demand when we get down to these 5.5% ranges, because that is more than likely nearing, the floor of what we can expect moving forward.
Yeah, and this is what we saw at the end of 2022, when we got under that 6.5 mark down to 6%. Buyer demand was quite strong, and this is based on all kinds of assumptions, but based on today's housing prices, what people can afford, how do interest rates play into that, et cetera. But this is kind of our rule of thumb that we're using right now. And if we see that inflation comes in higher than expected, and they start notching up those interest rates with the Fed, and interest rates get back to 7.25%, 7.5%, I do believe that buying activity will slow down in direct correlation, because simply the buyers are going to have a tough time affording it. But at that point, then we're going to definitely look into that recessionary world, and then we have to figure out how we exit that. But this is the rule of thumb that we're going to use at the Ladd Group for the next couple quarters on projecting buying activity and demand between that 5.5% and 7.5% interest rate. Fair?
Absolutely, yeah. And then, back to what I was saying earlier, as those interest rates move, that feeling of comfort will adjust in terms of where it has been most recently. But for the foreseeable future, we're imagining rates being in this range, and buyer activity being a result of that, for sure.
Okay, so we are at 35 minutes now. Thank you all for lasting this long. We're at a question point. So we've presented the data we're going to present. If you have any questions, please put those in the chat or the Q&A, and we'll bring those up. If you don't have any questions for us now, we do have some of the kind of general questions that we're hearing from our buyers and sellers. And this is the lightning round. And so Steve, question: when your client says, "Is housing going to crash?" what's your 10-second answer?
Well, I would tell them to watch this webinar.
Yeah.
And I would tell them that the factors are very different. Looking back at what we've seen over the last 6 months, that's a very good indication of what we can expect moving forward, not what we saw 10 years ago.
Yeah.
That's my quick answer, and we can go through all the details on why that is. The answers to the next 2 questions, nobody likes, but the answer is it depends. Should you wait to buy? It really does depend. What are the factors that are driving the discussion? Are we talking about you're needing to get in because of a new job, because kids have school, because you got to get away from a certain altitude, you need to, whatever it might be? There are a bunch of reasons. In terms of the market, it will be driven by how much you can afford with regard to interest rates. Is there a home out there right now that looks appealing to you? Should I wait to sell? This factors in with that. What is the inventory going to look like moving forward over the next few months? Historically, every spring, we see new listings pick up between the beginning of the year and roughly June, early summer, and then we see that taper off. Like Brian, like you said earlier, we don't know if that will happen this year. We know that new listings will come on, but what about those people that have a 3% interest rate and were really only interested in selling if they could get their aspirational pricing? Those people might not jump back into the market. So we might not see builders not listing their homes in pre-sale, many of them waiting until they have an accepted offer before they even start construction. That'll artificially keep inventory lower. So, really the factors are what's driving the discussion on whether or not you should buy or sell.
I think those are all really good points, and it's not dodging the question because it is specific for every single client. What I've found is the longer I'm in this business is the less we can predict on a month-to-month or quarter-to-quarter basis. But those that have succeeded in wise investments that have met the needs of their family, met the needs of their financial goals, are all about time and market and not market timing. So it's how long are you in housing and time and market rather than trying to time the market just as it is in stock market. And those that make calm decision based on their needs and not what everyone else is doing. So those that were purchasing during the pandemic because everyone else were buying, those are the people that have buyer's regret right now. Those are the people that are going to get mortgage rates higher than they really want just because they're panicky. And what I do love is that as things have slowed down, we're back to the point where we can be of value to our clients because we can help them make calm decisions that benefit them in the long run. And in those couple quarters, couple years, 2021, 2022, it was hard to have a calm buying experience. It was hard to be rational and it was hard to remove emotion. And I, for one, am thankful those days are in the rearview mirror and we can go back to making smart decisions in real estate that allow you to sleep at night. And so it's different for everybody. But I am excited that we're back to a point where our advice matters, our representation matters, and buyers and sellers can take a deep breath and make calm decisions.
I mean, that's a very fitting way to end it. We really hope that everyone can take this information. It is some specific data across a broad range of factors, but the reality is individual conversations, talking about what affects you is what is the most important thing. And, we hope this is the start of that conversation for any of our new clients, for our existing clients. I mean, I think you can tell Brian and I and everyone on the team that we love to talk about this stuff. And, we look forward to continuing to be able to offer that perspective.
Yeah, and Steve, you put a ton of time into that market update. We have a state of the market that is so for the data wonks on the webinar today, send us an email. We have a 6-page report that we do quarterly. Are we doing it semi-annual or quarterly?
Semi-annual.
Semi-annual. That goes deep into this data, and we'd love to share that with you. So thank you all for joining today. I can't thank you enough for taking your time, and please reach out to us if you have any real estate questions. We're here for you, unless it's a perfect powder morning, and I've only snuck a few of those in this winter, but I'm going to try to do a few more.
Good news is the rest of us are still in the office on those powder days as well. So that's where the team comes in.
I started at 4 a.m., so I was done by 10. Okay, thank you, everybody. I look forward to seeing you next time. Take care.
The thing that is so unique is I always feel like they're looking out for the best financial solution and also the solution that works great for our family. They were getting referred to me also by so many other people too. People saying, hey, you need to talk to the Ladd Group because they get great results. And so that's how we connected with them.